Welcome to the daily futures analysis. Today, December 9th. It's currently almost 3:30 p.m. Eastern time, and I think it might be a good time to sell some puts on silver and on copper based on a few factors. But obviously, we have the rate cuts decision tomorrow, so I'm gonna do nothing up until we know we actually have a rate cut or not. But let's go over why silver and copper. So mainly silver. If you look at the volatility at the CVOL, the commodity volatility index, it's relatively pretty high, especially with the price moving upwards today. And then copper is also not too bad. It did go down today. It was at a bit of a better level, but I would still consider this a pretty safe level, even though this is really on the edge of of being not that good of a volatility for me to sell options. So we'll see what's going to happen tomorrow, but for now, it looks quite okay. So if you look at a graph for silver, now this is obviously not exactly what I'm going to end up doing, but this is just kind of approximate. This is what I do basically every single day, multiple times a day, just kind of get a feel of where I can get what fill price. So for example, I am going to be looking at the 45 put strike, because you can see this is the previous swing low for silver. Price is quite far away from it, so I just want to see what kind of credit I can get. And I'm pretty sure we're also going to end up using a different silver contract. So let's just click and see what we can get. And we're looking at, let's look at 49 days to expiration, which is the March contract. So we currently have the December contract, so we'll delete that. We'll add silver March, which is right here. Perfect. And then we'll add, perfect, there we go. So here the strike is, well, we can go to 46 here. I guess it's the prices are a bit different between contracts. So let's go to 46 and see what kind of credit we can get at 56, or is it, yeah, 46. 46 is the strike. Let's see if we can get any meaningful credit at 46. So as you can see, it's quite far out of the money. Let's see, here we go, 46. Let's see if it's even worth it. If not, so we can get, it's not bad, $480 in credit, about $15,000 in margin. The max I would go is 2 contracts. Now this is definitely not enough for me to take the risk. So this is, for a 100K account, only $960 in credit. And I definitely don't want to go over for the contract amount, and I don't want to go and increase my my pull strike. So what we can do is we can try to go to the next cycle, 77 days to expiration, which will have reach our premiums, obviously. So let's go to strike 46 here, and I'm assuming we're going to be getting way more credit. Perfect. So here for 2 contracts, we can get $2,290, which is quite a bit more. So this is something that I will definitely consider, especially given the high volatility. Any drop in volatility is gonna cause the option to lose value, especially given that options with a higher expiration have a higher sensitivity to volatility. So this might be a pretty good play depending on what's going to happen tomorrow. So let's see, and let's take a look at copper as well. And again, this is just kind of raw. The raw process of what I'm doing. I'm looking for good volatility, and then obviously I have my own fundamental analysis. But as you can see, obviously prices are pretty, pretty bullish. So if anything, it's only selling puts for myself. So if you look at copper, March is the correct contract. We have March. So let's see where we can safely sell something. So I would ideally want to sell something at probably 4.6, but I don't think we can get any kind of good credit at 4.6, because it's really, the most ideal case is going to be 4.5, but I'm pretty sure we're not going to get any credit at 4.6. So let's see. 4.6, I'm going to go to 77 days to expiration right away, because I know it's not going to be that lucrative. It's 49 days to expiration, so we can get, actually not bad, one contract at 77 days to expiration, $4,000 credit. You can go whatever, 4 or 5 contracts, and it's quite good. Actually, we might be able to go to even 5 contracts. There you go, 4 or 5 contracts, and you can collect quite a nice amount of credit. 77 days to expiration. Strike 4.6, which is really far out of the money. And then obviously taking profits at 50% of credit. What delta is it? Let's see here. It's delta 9 over here, so it's not too bad. And then 4.5 is going to give us, I think, a little bit less premium. Yeah, a little bit less, but actually quite nice amount of premium. So 4.5, even better actually. So I'm pretty happy with it, yes. So the big difference is also to remember is the volatility here is the volatility for the front month. So for the expiration that is the closest, and not for the back, or not for any of the different months. So we're currently on the March expiration, but the CVOL is for the December expiration, or whatever the front month is, December, January, I'm not sure. So it's gonna be a bit different, but it's still gonna be very, very similar. So here you go, 4.5 for copper, 46 for silver. Pretty good expirations, pretty good positions, but we'll see what's gonna happen tomorrow. It's too early to tell. Price can move up and down today, tomorrow. So this is it for the daily update. If you have any questions, let me know. I'm going to start making them daily, just kind of showing a really raw process of what I'm just doing every single day. I think this is going to be really helpful for people. So let me know if you like it. If you don't, also let me know. And I will catch you tomorrow with a new video.